now that we have some of the core assumptions in place, we can start forecasting the income statement and the cash flow statement. That's ultimately what we're going to need, because at this point, we've got a sense of how much we're going to pay for this company. And the thing that's going to determine what our returns are going to be is now whether we're going to generate sufficient cash flow to pay down debt, and ultimately, coupled with the exit multiple assumption that we're going to make, we can then determine what the IRRs are going to be, what the returns to the sponsors are going to be. So this is kind of where we turn now. First thing in forecasting is looking at the income statement. Obviously, once we get the income statement in place historically, we can start talking about forecasting, and then we can shift gears to forecasting cash flows. Income statement is sort of the first piece, and then we combine that with some cash flow forecasting to figure out how much debt we can actually pay down. Okay, so the latest financial statements, as you know, are as of the pre-LBO 10K. So the 10K has been included in your files, and if you scroll down to the income statement, here we are, page 81 of the PDF, or page 56 of the document. And we see their revenues all the way down to their net income. So let's go ahead and put that in place. So I'm going to do one with you guys, and then I'll ask you to put in the prior 2 periods historicals. One thing, notice that we're hard coding the last 3 historical periods: March 31st, 2013, March 31st, 2012, March 31st, 2011, and then we're using a formula, the EO month function, to forecast. That's consistent with how we've done in the past. Again, we're the P for projected, A for actuals. We're using the year function to extract the year out of the last reported year, and then we custom format that to put an A there. And really, you don't need all these bells and whistles. All you need is really this and an A, and you're good to go. Same thing here, except we custom format that to have a P, and that sort of distinguishes that these 3 are historicals, these are forecast. In terms of the forecasting period, since the typical holding period for private equity firms for when they sort of expect to get rid of the business or exit the business is anywhere from 3 to 5 years. So an LBO model tends to be an annual model with a 3 to 5 year sort of forecast. The historicals, 3 years is almost always sufficient. So let's lay down the groundwork. Just one final thing in terms of you could have also tried to make this a formula, the historicals, but historicals are not always the same date. Sometimes when companies report off calendar year, like this company does, where they have a March 31st fiscal year end, sometimes it might end on March 30th or March 29th. It just so happens that they all ended on March 31st, but it's actually a better practice to just hard code the historicals. And then you can, of course, forecast using EL month for the future. Okay, so let's put in the revenue here. Okay, so now let's look at the operating expenses. So we're going to break down operating expenses into cost of goods, or as they say, cost of license revenue, cost of maintenance revenue, cost of professional services revenue. So we're going to add all that up and create a separate line item for that. So let's start. Switch the sign here, just like our typical convention is to make these expenses negative so that this is just a sum. All right, R&D's 174, switch that sign. So SG&A, we're going to add up these 3 line items: selling and marketing, general administrative, and amortization of intangible assets. We're going to spend some time talking about amortization of intangible assets, and because it's actually important for forecasting EBITDA. The way that most models forecast EBITDA, they sort of add back the amortization. So we're going to spend some time talking about that. For now, let's just kind of add up all the line items. Switch that sign. And then that way we can have just a sum function here. Could have also just done a sum function here as well. All right, interest income, 8.3. Interest expense. And then any other non-operating income and expense. This is a gain on sale. So expense is a negative, gain is a positive. And again, that enables us to just always just sum everything, makes things easier. And then last but not least, we have taxes of 96.9. As a sanity check, I always just kind of make sure that our numbers match. We can do sum again. That our numbers match theirs, 331 exactly. That looks like that's the case. We don't actually care about EPS or shares outstanding in an LBO necessarily, so we can just stop right there. Let's format this nicely the way we like to. Hard-coded numbers are blue. You also want to just kind of bold the sub calculations. And the other thing that I want to do before letting you guys loose and doing this yourself is an EBITDA reconciliation. So notice that these are GAAP-based results that we've inputted. We haven't looked at any non-recurring items or anything like that. And so let's do that at least for EBITDA. I want to make sure that the EBITDA that I'm calculating excludes anything out of the ordinary, because really EBITDA is a driving metric here for valuation, as you've already seen, and for a lot of analysis, including your debt to EBITDA ratios, leverage ratios. So let's just make sure that EBITDA is sort of in line with how the company discloses their results. So as we've talked about in other classes, where you often get a GAAP to non-GAAP reconciliation is in company press releases. BMC is no exception. If you go to that, the same day they also issued their fourth quarter and full year results press release. I've included that in your files. And there they have the same income statement, but in addition to the income statement, notice here they've got a whole discussion about their use of non-GAAP financial measures. That's what we're looking for. It's the sort of deviation away from GAAP-based reporting to show results the way they think is more relevant for the purposes of analysis. So the things that they, for example, exclude from their non-GAAP presentation is stock-based compensation expense, which is buried throughout these operating line items, presumably. If you look at the footnotes, you'll see that there's stock-based compensation buried across all these line items. There's this whole expense that, for the purposes of non-GAAP presentation, for analyst-friendly presentation, we pretend like that doesn't exist, and they're explaining to you why they think that you should pretend like it doesn't exist. Same with amortization of intangible assets. That line item that they identified here, they're, for the purposes of non-GAAP presentation, as you'll see in a moment, they're ignoring that number. They're saying, hey, that's not really useful for the purposes of really analyzing, and these are the reasons. Severance, exit costs, and other restructuring charges. They're in the midst of a restructuring, so they're excluding any severance costs, any things that they think are sort of one-time items that aren't going to persist. They also had a proxy contest cost of $5 million, which they want you to exclude. And the final thing is they're saying, hey, if we're excluding all these things, we also wanted to show you what taxes would be like if you ignored all these items, just to be apples to apples. There's some other discrete tax items which actually are not going to be that relevant for us. So it's sort of the pre-tax stuff that really matters. So let's take a look. So here's that same income statement that they reported the same day on their 10K, that $331 million in net income. But then if you scroll down below, past the balance sheet, past the cash flow statement, you get this GAAP, non-GAAP reconciliation. BMC actually provided the same non-GAAP reconciliation in their 10K. So you didn't really need to go to the press release for this company. Sometimes you have to go to the press release to get this kind of good stuff. But other times, like in this case, you have all the information you need. I'm just going to scroll to the table that lays it out in the 10K. Here it is. So it's the same information right here. So we can actually use this one. Let's present it a little more nicely. So what they're saying is, hey, that GAAP operating income of 465.4, let me go back to our model, 465.4, you need to exclude a whole bunch of stuff from there. There's a whole bunch. There's $147.4 million worth of stock-based compensation expense you need to exclude. So let's do that for EBITDA. You can also sort of adjust for the income, adjust it straight out of the income statement. A lot of models do that. I don't think it's actually necessary for us, because what we really care about is EBITDA. So as long as you understand what you're doing, this becomes easy. So we start with GAAP-based EBIT, and we're saying, hey, let's add back stock-based compensation of 147.4. Okay, let's go back to the filing. They're also saying, hey, add back, we're going to skip an intangible asset amortization for a second. Let's also ignore severance, exit costs, other restructuring charges, and proxy contest costs. So these sort of one-time items, 36 million plus 4.9, we want you to ignore those as well. So let's ignore those, 36 plus 4.9. Let's ignore that. And also, for the purposes at least of getting from GAAP operating income to non-GAAP operating income, we want you to ignore amortization of intangible assets of 86.9. Well, so if we were trying to get to non-GAAP EBIT here, that's all we need to do, and we get to non-GAAP EBIT. And what's interesting to note here is that this gets you that non-GAAP EBIT is actually earnings before interest, taxes, and amortization. Notice that it actually takes out amortization. It excludes amortization expense. And just so that everyone's clear, that 86.9 million, you can sort of get a full breakout of sort of where that's buried in the income statement in the footnotes as well. Just like with stock-based compensation. Stock-based compensation, I mentioned, is actually like buried within all these line items in a footnote. So here's a footnote that tells you that 147.4 million, it's across the cost of license, cost of maintenance, SG&A. These are all the stock-based compensation expenses. This is where the employees are. So the stock-based compensation expense is classified within the expense categories where the employees generating that stock-based compensation actually sit. Same thing with intangible asset amortization, sort of a function of what is the expense category where the intangible assets are being expensed or cycling through on the income statement. So, but we don't want non-GAAP EBIT. We want non-GAAP EBITDA, right? And so that's a bit of a redundant thing because EBITDA is fundamentally non-GAAP. It's not a GAAP measure. So what we want is we want to add back not just EBITDA, earnings before interest and taxes and amortization, but we want depreciation and amortization. Well, where can we find that accumulative sort of bucket in the cash flow statement? The cash flow statement is where you're always going to find depreciation and amortization identified together, almost always, I should say. So here's their cash flow statement, and you see that D&A combined is 229 for 2013. So we add that back here, and we have $883 million in EBITDA. We can finally actually link this EBITDA that we had hard-coded as 880. We can actually now link to this. And we got a little bit lucky in terms of the timing of the filings, that since the latest filing for BMC is a 10K, it's the LTM calculation for EBITDA doesn't fundamentally have to come from the last year. We just got lucky. If the last filing was as of the third quarter, we'd actually have to go through the process of calculating EBITDA by taking the last year, adding the stub period for this year and subtracting the stub period from the prior period, like we've done LTM calculations in our comps training, for example, and in our DCF training. So this time we avoid that because the full year, the 10K, is actually the LTM. This doesn't have to be the case. Just be clear on that. So at this point, I'd like you guys to do the same thing for the prior 2 years. And then I'd also like you to take a stab at calculating the growth rates and the margins for the 3 periods. In the next video, I'm going to complete the growth rate calculations, and I'll already have the historicals baked in so we can move on to forecasting.